Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. We're going to get some information now on buyback ETFs with our research director of ETFs, or ETF research director, Nina Mishra. Nina, you have been following these for a while now. Mm-hmm. First of all, dividend ETFs are popular this year. A little bit expensive maybe though, huh?
Yes, they have been very popular this year, mainly because they are a nice investment option for income-oriented investors. And in this environment of ultra-low interest rates, dividend stocks and ETFs look rather attractive. So a lot of money has gone in dividend stocks and ETFs, and some of them look a bit overpriced now, because many of them focus on defensive sectors like utilities. They are typically higher dividend payers. Mm-hmm. So since these dividend ETFs look a bit overpriced now, I think people should also look at buyback ETFs, because this is another way the companies return cash to their investors or to their shareholders.
So can we say that buyback ETFs are better than dividends?
Dividends are usually more popular with investors because they are like cash in the pocket.
Right.
Buybacks are a little bit more difficult to understand, but they do reduce the share count, which increases earnings per share. So it increases the value of your share. Mm-hmm. And in longer term, you get a higher return from those stocks. They are more tax efficient too, because there are no dividend taxes or any kind of taxes on buybacks. And this year the trend has been that companies have been returning more cash to shareholders by way of buybacks mm-hmm. than dividends. That was the trend seen during the first quarter. In general, the companies have a lot of cash, they have low debt, not enough attractive investment opportunities, so they are returning cash to investors. But buyback trend has picked up this year.
Okay, so you have a couple of examples here. One, the PowerShares Buyback Achievers Portfolio.
Yeah, surprisingly, there are just two products in this space, wow. Even though these have been doing very well. So the first one is ticker PKW. It is PowerShares ETF, mm-hmm. and this index tracks companies who have reduced their share count by at least 5% during the trailing 12 months. Expense ratio is 71 basis points. It focuses on consumer discretionary, technology, and finance sectors. It's done very well, 65% return in last 5 years, 22% this year. Compare that to 32% and 16% for S&P 500.
Okay, and then the Trim Tabs Float Shrink ETF.
Yes, this is the actively managed product within this space. It is based on Trim Tabs research that the share price is a function of demand and supply. So it focuses on companies that shrink their float, and in addition to shrinking their float, they should have increased their free cash flow, and they should have not increased their leverage ratio. Charges an expense ratio of 99 basis points. This has also returned 22% this year, which is very good. And this also focuses on consumer discretionary, technology, and finance sector, which look reasonably priced, and they have an attractive outlook as of now.
All right, do you own either one?
No, I don't.
Okay. You can learn about other types of ETFs on our website, Zacks.com. So if you're watching this video in syndication and not already on the website, get on over to the homepage of Zacks.com. And near the bottom of the homepage is where you can link to the ETF section of our site. With Nina, I'm Terry Ruffalo.